And we are live. It is webinar time. Looking forward to this one. Welcome, Treasury community. Welcome, Treasury Masterminds. Today's topic, from analytics to decision making to new liquidity, a new playbook for working capital. It's all about working capital. That's what we talk about. We will talk about tech. We will talk about Treasury. We will talk about funding solutions. That's what we're here for today. Before we dive into it, a few housekeeping rules. There's room for comments. We love that. We promote that. Ask your questions, put them in the chat. We will see them, we will moderate them, and we go from there. Then let's dive straight into it. Don't lean back, by the way. We do have a poll question as well for you to ask, which will be put on shortly. So we definitely want your input on that poll question. So feel free to respond on the poll question, either in the chat or if you get a pop-up in your screen. So let's dive into it. Quickly introducing my panel. Ladies first, pleased to have Jessica Oku here. She's Treasury Masterminds board member, long-time Treasury expert. A lot of people will know her from LinkedIn, where she's eager to share knowledge as well. Great to have you, Jessica. Next, we have Wayne Mills, Chief Product Officer at ETR Digital, taking a bit on the tech angle, solutions angle of working capital financing. And last but not least, Oliver Berlin, founder and chief executive officer of Calculum, taking a bit the data analytics, AI angle of working capital. So much about housekeeping, so much about introductions. Let's dive straight into it. Like I said, I would love to start with a poll question to you, to the audience. Please give me your answers. You should see the poll question in your screen where you can answer the question. If you don't see it in your screen, just put the answer in the chat. The question I want to ask you, what is currently your biggest working capital challenge? Is it number one, technology integration? Is it number two, supplier payment term negotiations? Number three, internal processes and complexity? Or is it number four, access to funding solutions? Either answer it on the poll immediately or put the answers in the chat. Number 1, 2, 3, or 4. Before we wait for this, what do you think the most popular answer will be? And let's start with you, Jessica. What would you choose?
So for me, I'll choose internal processes and complexity.
And why?
Yeah. And the reason I'll actually choose this, although my view is that most working capital challenges are connected because the thing is with poor or weak forecasting, right? Or I'll say weak forecasting delays decisions, and delayed decisions reduce liquidity options. So the thing is, when ownership within the organization is unclear, when it comes to like working capital optimization, right? Even the best technology will not translate into cash for the corporate, right? So that's really why I would choose internal processes and complexity, because the opportunities within the business, and then that work has to be done and ownership has to be taken to achieve that, right?
Interesting. So looking at the answers, the main answer here is actually technology integration with a fair runner-up of number 4, access to funding solutions. I don't see anybody talking about supplier payment term negotiations and a bit less on the internal processes. I can get the supplier payment term negotiations. That's often a different team who manages that one and takes care of that. So Treasury shouldn't worry about that one too much, though it affects our Treasury processes. Wayne, looking at this, are you surprised? It's all about the technology.
Yeah, well, I'm delighted in some ways. As a technology company, obviously, we can help with a real problem. But I think, look, I think it will certainly depend on if you're in a large investment grade multi-site organization, or perhaps a sub-investment grade organization, if you're in a developed market versus a more of a developing market. So I think there'll probably be behind those, there will be a different story. But I think the common theme I would observe over certainly the last 5 years minimum is there's still an island of fragmented technology solutions, and actually we still lack a single utility in terms of bringing these together for the Treasury community. So I'm sure we'll get onto this as we go deeper, but no, it doesn't surprise me at all, to be honest.
Yeah. Oliver? You're on mute, Oliver.
It depends also obviously on what type of solutions you're looking at. Some solutions to finance working capital don't need any integration or different complex systems. But yeah, and then as we said, look, we are all about optimizing payment terms. So I think today would be good to show a little bit more, provide a bit more information to the Treasury audience. What does it mean? And then maybe next time they put it as a top priority.
Yes, interesting. Let's start basic. Let's start from the Treasury angle. Jessica, how important is working capital for Treasury? Because Treasury already owns cash management. We do FX, we do funding. Should we have working capital on our plate? And isn't it a wider business topic? What's your take?
Okay, so my take on this is that I really believe that working capital is a Treasury topic, right? But it quickly becomes a business topic as well, because Treasury is responsible for ensuring that the company is liquid. That's really one of our strategic mandates, right, as treasurers. And we know that the cheapest source of capital is the cash that is already within the business. So, but the challenge is that, Treasury does not create receivables, neither does Treasury determine inventory levels. It also does not even negotiate supplier payment terms anyways, right? So those sit with cross-functional teams like procurement, like operations and even sales as well, right? So, this is something that Treasury, I feel, should in a way take ownership from. But the business or the executive team, right, has to take or drill out that mandate strategically from top down. So while Treasury may own liquidity strategy, the business owns many of the operational decisions, like I said earlier, that ultimately determines liquidity outcomes, right? So, and this is why the most successful organizations are moving away from just viewing working capital as a finance initiative, as a Treasury initiative, but instead what they're then doing is treating it as enterprise-wide responsibility, right? So reiterating this is really very critical, but I still believe that the ownership, because of the strategic mandate of liquidity optimization, sits with Treasury, right? But it has to have that wider executive level support.
Mm-hmm. And which KPIs gets the most attention from management? Is it the full cash conversion cycle, DSO, DPO, or any other ones?
So what I would say is that it's free cash flow, right? And because it shows that, or it shows if the organization is generating liquidity needed to fund growth, to be able to reduce debt, invest in innovation, and reward, shareholders. Also, while we're dealing with on a certain global or macroeconomic environment, right? But then, even if I say free cash flow is like the priority, right? It's an outcome. So it's very important to understand what is driving this outcome, right? And that's where we then go into cash conversion cycle, right? So because it really then measures how efficiently the business converts all of its operations, operational activities into cash in itself, right? So shorten your DSO, optimize your DIO, and then extend your DPO, right? So it tells us, I mean, the CCT basically we all know tells us how long cash remains inside the business within its operating cycle before then returning back to the organization, right? And we all know that when you shorten your entire cash conversion cycle, it will free up internal liquidity instead of having to leverage on external financing like debt or equity, right? So and an example I would say is maybe if a company is generating, like, for example, 1 billion in annual revenue, right? If you can even just like get an improvement by 1 day on your cash conversion cycle, that's like saving $2.7 million, right? So yeah, that's why I'll say that free cash flow priority, right, for growth perspective, and then cash conversion cycle to free up internal liquidity.
Yes, interesting. Oliver, is this what you see around your client base as well? I saw you nodding. I saw you thinking.
Yes, look, we speak with a lot of corporates, treasurers, procurement people, and across the board. I mean, I think the last year that maybe there was only maybe one company where working capital was not a key topic. So I would say everybody right now, everybody is looking at working capital, at free cash flow. And I think the main reason was the working capital was always a target, same as increasing sales, profitability. But right now, since a few years, it has gained importance. And I would say because the key reason many industries growing sales is very difficult, correct? You have very small margins. Reducing cost also very difficult. So the only way to really generate cash flow is by optimizing and improving efficiencies in your cash-to-cash cycles. And yeah, so and as Jessica said, we see also a big change where before it was the people who understood working capital in different ways how to improve it was mainly the CFOs and the treasury. But right now, because you need operations, the people on the ground making it happen. So we see chief procurement officers, salespeople, they all understand the benefit of getting paid earlier or paying later and what does it mean for the organization. So the knowledge across operations has dramatically increased.
Yes. Okay. From your company, you analyze a lot of working capital data with your clients. Tell us about some surprises, some weird data trends you're seeing.
I mean, yeah, one thing when we started, logically, we looked at all the companies where we were finding like the key working capital metrics, like you mentioned before, DSO, TPO, and the inventory. And we obviously looked at the ones which are the worst performers, correct, in every industry, because we thought, okay, these ones would be the perfect target to offer our solution. And actually, it was the opposite, because, and I believe the reason is there's a reason why these companies are laggards or are not good in managing their working capital because they don't care so much, they don't put so much importance. And there's a reason why the companies which are the forefront, the best leading organizations generally, are focusing on working capital. And these were exactly and are today our clients. So they see such an importance, and it's why they are constantly trying to further improve their working capital and generate free cash flow because they see it as a competitive advantage. And maybe I always, usually during the first calls when I speak to a company, to a prospect, I always explain it's not only about free cash flow. Is if you, let's say, if you look at the payables, correct, in your suppliers, if you pay your suppliers earlier than everybody else, obviously you're financing, you're acting as a bank, and there's a cost to that capital. But it's not only that, is the supplier is happy because you improve his liquidity, but the supplier is using this liquidity usually to be able to accept longer terms from your competitors. So you're not only financing your supplier, but you're also financing your competitors. So it goes way beyond just free cash flow. It's about competitive advantage. And we have many examples which were very successful like that, Apple, Amazon, many others.
Yes, it's very interesting perspective. Wayne, can you add to this? You see trends in financing solutions now versus years ago. Do you see changes in the market? How treasurers are financing, especially working capital?
Yeah, absolutely. And I very much echo what Jessica was saying before and Oliver about the strategic versus tactical. I think certainly 5 years ago, most corporates I spoke with focused on liquidity almost as a defensive measure. You know, have we got enough cash? Have we got enough cash in the right place? And how accurately can I forecast? You know, I think increasingly it's now seen more of a strategic asset. So, you know, we're having questions, you know, with our corporate clients around, well, how do we unlock that trapped working capital? So back to the cash conversion cycle, how do we create the optionality without increasing leverage? Because actually, you know, the accounting treatment, the balance sheet treatment becomes important as well as the solution and the cash generation itself. So I think, I mean, we working with clients across Latin America, Africa, Europe, of course, the Middle East. And I would say there's certainly similarities in terms of that more strategic view of working capital, and it's a board conversation rather than just sitting in the treasury function. But you then get to the drivers, and the behavioral drivers are different in different markets in terms of cost of capital, in terms of access to local currency. So there are certainly differences. I mean, there's quite an interesting point actually. Be interested if the others see it as well, but there is still surprisingly a misalignment of KPIs across regional treasury centres. You know, so we typically think about this topic at, you know, from the parent level, but some of the conversations we have, you know, with an APAC regional treasury centre don't always still align with, you know, their colleagues in Africa or in Europe. So I think it's certainly an opportunity for corporates to really get back to basics and say, if you can align those KPIs across the wider business, actually then how you solve those issues actually becomes more efficient and actually will then benefit the group. So we talk about, you know, new techniques around, you know, receivables and dynamic discounting and supply chain finance, which increasingly are becoming commoditized in my view. And actually the point of differentiation is how they can feed into digital workflows and the digitalization of those workflows to get the efficiency, because actually just simply generating the cash, customers tell me, you know, it's no longer enough. It has to be a more strategic, operationally effective and cash flow effective, balance sheet effective solution. So yeah, it's a good mix, but definitely echo the strategic enterprise level importance of liquidity.
Yeah,
for sure.
Interesting. Just to summarize what I heard in this intersection. So historically, Treasure's already focused on cash, visibility, maybe a bit on forecasting. What I hear from you all now is there's more focus on structurally optimizing the balance sheet, the full working capital, and to be honest, the whole cash conversion cycle as a whole. Which is quite challenging because there is no working capital department in any company. It's shared by many. Putting it fully on the treasurer, I have my doubts. We'll come to that later, Jessica, definitely. So I think we need some sort of tech. We need automation. We might need, here comes the word, we might need AI to help us out. So Oliver, looking at you, everybody talks about AI in Treasury. So are there already practical use cases here that deliver value in working capital? Real use cases.
Yeah. So maybe before I have to explain. So what we are doing. So it's very easy to explain. We are analyzing thousands per day of supplier-buyer relationships and analyzing their payment terms and help these companies optimize and negotiate better payment terms, correct? With or without financing involved. So as it takes a lot of data, and whenever I go to conferences, and I'm sure the audience has the same view, you ask somebody or a vendor, you ask like, hey, how you come up with this number? It's always like AI. It's always this black box. And how we look at AI is first, the data is the key, correct? When you look at all these models, they always usually the foundation is publicly available data. What we leverage is data which comes directly from the company's ERP systems. So basically what payment terms they currently have with their trading partners. So it's not a black box. You actually can see how many occurrences we have in the database, what are the averages this supplier or customers are accepting, and if they're using financing or not. So for us, and the second reason is we're not using AI in this case because we're not even allowed. So what we have seen, it started maybe 2 years ago. Everybody is very cautious about the use of AI, especially when it comes to data sets, correct? And we are dealing again with a lot of data. So we are not allowed by contract, we're not allowed to use any public LLMs like Gemini from Alphabet or Claude, Anthropic or ChatGPT. We're not allowed to do that. So what we have to do is build our own private AI model. And we are only using that, to answer your question, to predict negotiations. So to tell you first, where are the low-hanging fruits? Like, to give you an idea, clients which we serve, like Campbell Soup, Philips, we're analyzing 50, 60, 100,000 of their suppliers. So you're not picking up the phone and negotiating with so many suppliers. So you need to know where are the low-hanging fruits and what is the probability for each supplier if they will accept these new payment terms. So for that, we are using AI and more advanced analytics model. The second is when you negotiate payment terms, obviously you can say, hey, this is just my new standard. I'm just moving, let's say, to 90 days. But as we know, it's not always so simple. There are many, many factors which play a role, like regulations, what others are accepting or providing. So for that, we use an AI model which creates negotiation scripts, which allows you then to navigate every discussions or pushbacks. And the third one, which I'm the most excited, which we are now releasing in a few weeks, is which is the next step, is where the AI can negotiate on your behalf, so agentic negotiations. And it's surprising, but it's not us which are pushing that, it's the companies. The companies, the large organizations, they are moving faster than, I would say, the market. They really want to introduce that. They want to do more with less people, and they are testing all these proof of concepts using AI in their negotiations.
Yes, interesting. Jessica, if you hear this as a treasurer, treasury is often a small team. You know how it works. We have the full workload. We own half of the balance sheet. Would this be a solution to help us get rid of our workload, or will it just add workload to our already small teams?
So for me, I'll say that, AI does help because, when we're looking at, like you said, the composition of teams are usually smaller, right? Although for me, right here as a treasurer, I manage 10 people anyway. So, but yeah, coming back to average, on the average, maybe like 3 to say 10, 3 to 13, right? In terms of the composition, right? So, and looking at, so AI will help, right? Help us in the instance where traditionally, working capital analysis was maybe probably done periodically. And, you have to analyze large set of data on spreadsheets, right? And all of that. And really, you had to take like a backward looking position because you couldn't be able to predict, analyze data that fast as a human, right? Even if you have the most advanced, analytical capability, right? There was still some limitations around what teams can do in terms of that, right? Because you then have large volumes of suppliers. I mean, you see, Olivier had mentioned, right? You have customer, you have invoices, you have payment contracts, you have purchase orders, even like behavioral data and all of those things, right? So to be able to analyze all of those patterns, all of those data and all of that, right? You really need to leverage AI. And AI, I see, will be very important for us with that capability, right? Because And how I will put it will be in a way that it will do this for us faster, in a way that we can then use those insights that AI generates to be able to make decisions, take actions, and actually optimize working capital, right? Rather than spend the time doing the analysis and then having to get the insight and make decision. By the time you finish all of that activity, the business environment has changed, right? And I don't really see the business being able to leverage or achieve that competitive advantage that it intended to, right? So yeah, we do need it.
Interesting. So Wayne, we have AI, we have treasury capacity. Hearing here, it's all about the data. We need clean data. We have too much data to put in Excel. So what data points do we need in working capital to make this work?
Well, I think from a perspective, so as an ex-banker, I suppose, I would say there is absolutely no shortage of data, but there is a very significant shortage of insight in terms of what do we do with it. So I think there's a struggle, or there has been a historic struggle. I think in a working capital context, I think first of all, there's the obvious sort of operational metrics around cash conversion cycle that we've already talked about in terms of DSO, DPO, DIO. There are then some behavioral metrics, and again, I think AI can be quite helpful. Something as simple as a Kreljic analysis, looking at the risk and the business impact, and to run that type of analysis across tens of thousands of suppliers becomes actually then quite an efficient story. But it's not the data itself; it's then what better management decisions can you make now you know what you know, in a lot more quickly. I think the third thing I would say, and relating to data, but more broadly, is trust, actually, because again, huge amounts of data being processed, but actually, do boards, do management, do teams trust the outputs, and therefore have enough confidence to trust the decisions that are made off the back of it. We have that in our business. We produce what we call digital working capital notes. For those that know, it's a bill of exchange or it's a digital promissory note. But actually, what we find is, it's the law allows them to be used globally. They're a very effective tool. But for those people that don't know, there is that initial sort of education and understanding needed to say, actually, yeah, this is something I can trust. So I think we should all recognize when we talk about data, when we talk about what that leads to in terms of actions, whether it's agentic AI or good old human intelligence, then I think it comes down to making sure there is that bridge in terms of trust, and making sure then the decisions you take actually align them with the objectives. And again, just making sure it's all triangulates quite nicely.
Yeah, interesting. But then you have this triangle. Oliver, I want to ask you, because now I hear a lot about data quality. I have the AI who helps me. That will give me output for treasury again, but procurement has to take the action. So then the circle is round. So do we need both data quality and the AI? But we also need those humans, treasury and procurement, to work together. Will AI help us, or automation? Doesn't have to be AI all the time. Align better between treasury and procurement teams or sales teams, because I do sometimes see lack in that one.
Yeah, so as we all know, especially working in the past with supply chain finance programs, which usually it's initiated by treasury and finance, but then the actual people which make it happen are the procurement people, purchasing people, departments, and usually they don't have the information available to execute on that strategy. Correct? They just say, hey, here's the financing program, and this is our working capital goal, and let's make it happen. And as we all know, many of these programs are not a success or have not achieved what they what was expected by these facilities. And the reason is because there's no common ground in terms of information and collaboration. And so we see that having a platform or information available, data to be accessible by the procurement team and the treasury team, to basically, based on that, you know exactly what is the opportunity, again, what is the good case and the base case, what you can achieve in what time frame, and where are the low-hanging fruits. And then also having the possibility for both teams to create a plan, because obviously treasury needs to know how much is achievable in 6 months, in 12 months, because they need to report. Sometimes you don't want to have everything in 1 year, correct? You want to scale it over the time. And then very important, having a plan is useless if you cannot track it, correct? So tracking the progress, making adjustments. And for that, I think the data and platforms around that are very important. And then the other thing is AI, how AI can help this collaboration. I think AI sometimes can reveal insights which before it was doubt, or maybe procurement said like, hey, this supplier will never accept these payment terms, correct? And AI or data which is validated allows them to say, no, there's proof they would accept, or there's proof this supplier is already using supply chain finance or financing its receivables. So that helps to have a common ground again on an information level and to work together.
Yes, I think that's an important aspect, that the proof. Jessica, I want to hear it from you. I'm a treasury consultant, you're a treasurer. You've probably heard those sentences. We've always done it this way, challenging the status quo. Treasury is a small team. You really need to convince them to change or to take actions. Will this help? Is the data the proof?
Yes, I think it will help, right? But the most important thing we need to look at is the fact that, what's the quality of the data? Very critical, right? And, because before you can take effective decisions, right, that then will improve the liquidity position of the corporate or the institution, you have to be able to, ensure the data is correct. So as long as the data is correct, definitely you can then leverage that insight to make decisions or take actions that then help you see visibly what the liquidity improvements will be, right? So yes, it will really be helpful to a lot of teams, and technology as an enabler, right, would really facilitate that, yes.
Yes. Okay, very interesting. So I think we've covered the technology part, the number one topic in our poll. Second main important answer in the poll was alternative financing solutions. Wayne, you already mentioned working capital notes. Bit of intro, working capital for treasurers, often a pot of gold where we can find a lot of liquidity, but it's also a headache for us because most supply chain finance programs, they are tough. A lot of documentation, a lot of paperwork, a lot of data to find and grind, also with our financing parties. So what's different on these working capital notes and how do they work?
Yeah, so I'll have to stop myself from being a boring banker here, but it's really quite exciting what's happening at the moment. So a working capital note that we produce is essentially a bill of exchange or a promissory note in digital form. And many people will be familiar with those instruments in a documentary trade context, perhaps with a letter of credit, and actually as a settlement instrument as one of the documents as part of a documentary LC. What's quite helpful is the law's changing and has been changing since 2017. There's a model law that United Nations put out, which was the model law on electronic transferable records, MELITA. And certain countries have adopted it. Certain countries are in the process of adopting it. Why does that matter? Because it transforms the use of these instruments, bills of exchange, prom notes, typically, in paper form. They go around the world. It was slow, it was inefficient, and there were lots of paper. Now, what we're doing with these working capital notes is using these instruments in a different context, so in an open account context. so supply chain finance and receivables, so both payables and seller and buyer led programs, you can use these instruments to essentially unlock more value, because they are, as many people will know, an unconditional payment order. It's a promise to pay. So on the receivables side, you take away the dilution risk, so you can get more money released into your working capital. From the payables point of view, you've got optionality for the corporate in terms of extending terms. And again, we'll look at the balance sheet impact and what does terms extension mean. But also for funding institutions, banks and non-banks, they have a really easy distribution opportunity, because these instruments can be transferred with a simple signature. So you don't need a long, detailed assignment agreements. So this concept of endorsement is what underpins the value and the strength of these documents and how they can be used in new ways. So the final point I'd make is the legal enforceability. So even in countries that haven't adopted this model law in terms of Melita into their own country legislation, there are still very strong enforceability characteristics of these instruments, because whatever the number is, 65-70% of global trade is done under English law, and actually the UK adopted this legal regime in 2023. So really exciting, I think, for corporates to say there is a different way of doing things. There's a renaissance in the use of bills of exchange and promissory notes that we call working capital notes. The final point on that is just actually always focusing on making sure we're solving a problem. So the technology we've built isn't, well, it's smart technology and it's quite cool. We know it solves a problem in terms of both larger companies and SMEs who still struggle to get working capital. So it's a win for corporates, it's a win for banks. So yeah, we're really excited about how these can scale.
Yeah.
And I'll stop there just so I don't go on too much, but happy to answer any questions.
Yeah, no, great, Rich. We're in the last 8 minutes of the webinar. I already see one audience questions. We'll definitely ask that one. But just facing the audience real quick, if you have questions, this is your opportunity to poll Wayne, to poll Oliver, to poll Jessica about anything working capital related or treasury related. So keep these questions coming. In the meantime, Oliver, hearing this from Jessica, from Wayne, from you, it starts with data, optimizing my payment terms. Then I would go for Wayne in digitizing my working capital financing, getting rid of that paperwork. Is this a sweet spot, having both AI optimize first the payment terms and the procurement side, and then using Wayne and notes, digital instruments to help the treasury side and optimize that one?
Yeah, so I like what Wayne said. It's about always solving a problem or creating an opportunity for the client. Depends how you see it. But what we see is it's also not just selling a product, correct? So when we work with our clients, we analyze the entire spend or the entire customer base. And obviously, every supplier, every customer is different, correct? There's different leverage, there are different market share, they are in different countries, maybe with different regulations, and there's maybe different risks. So on a supplier that maybe the supply gets out of business because you're increasing too much your payment terms, or on an obligor, on a buyer that you provide them, you have too much exposure. So based again on the analytics and on the data, I think key is to see for which supplier group you can create what solution. So for example, if your terms are way too low with some suppliers and you just have to be successful in negotiating payment terms with the right arguments, why you need financing, correct? There's no need. If it creates really a win-win solution where you can offer financing and you can maybe improve the working capital for your suppliers or your customer, then you can introduce that. Sometimes, or many times, some suppliers, they're pushing back. And there's other solutions where you just improve your own working capital and you keep the same payment terms with your suppliers. So what I want to say with that is you have to analyze your entire portfolio of customers and suppliers and then adapt to the need of your clients and then offering the right product. Yes,
that makes total sense. Jessica, hearing this, we're talking a lot about real-time treasury. Of course, we need a bit of automation, connectivity there as well, maybe AI. Are we moving towards, maybe in 5 to 10 years, real-time working capital visibility in treasury? Would we want that?
Yes, definitely. I mean, I think there's no question about that, right? We would definitely want that. And then if we even look at working capital, like from 5 years from now, right? See, I believe that it will really, really move into a real-time decision, right? Or real-time decision mode, rather, that helps us to optimize liquidity across the entire enterprise, right? And the thing is that we're going to really move from explaining what happens to predicting what will then happen in the future. When you analyze the trend, the data, right? And technology definitely enables that to happen, right? So you'll be able to identify like payment risk, right? Supplier vulnerabilities, inventory inefficiencies, cash flow opportunities, and all of the host of that, right? Treasury in itself, I see us, then being able to operate like, operate and drive like enterprise liquidity optimization strategy, right? Which brings us back to what I would see, in my opinion, is part of our strategic mandate, right? So it will then be able to help us fund or help us to be able to direct effective funding strategy, right? To know that you're only going to leverage external financing when you actually need it, right? After leveraging all of the opportunities within the operating cycle of the business, right? So another thing I see is that, of course, there has to be that collaboration. We had reiterated it in the conversation, right? So that collaboration between like treasury, procurement, sales, operations, right? Because at the end of the day, it's still an enterprise level, like, priority that then drills down. But I see us, driving that in the future. And I see AI enabling us and, being able to release that liquidity that the business can then use to fund growth initiatives. So yeah, I do.
Yes. That would be really cool if that all is possible. Let's see if we achieve that in 5 years, in 10 years, or maybe only in 50 years, or maybe never. But let's see.
Let's work towards that, right?
But Patrick, just to make one point on that, if I may, I think the other thing we haven't talked about is the change in demographic. Because the way the 25-year-olds. Junior treasurers today, or juniors in treasury departments, they're the decision makers in the time period we're talking about, and their expectations of how they consume and purchase products and analyze them and assess them. I saw some research last year that 60% of the buying decision is made before the service provider is even aware that they have a need. So I think we should recognize that if we're predicting 5 years, 10 years ahead, it's actually those people that are making the decisions then will have very different expectations on how they consume financial services.
Yes, fully agree, fully agree. Also the expectations on automation, technology, and adoption on that side, but that could be a standalone webinar in my opinion. Let's use the last minutes for audience questions. Oliver, this one is for you. Negotiation scripts from AI, don't they get repetitive and predictive? ?
Yeah, I mean, look, you can probably, you have the person or who asked a question, or the audience, you can always ask Gemini what payment terms it would suggest, or what negotiation script, and then it's repetitive. But if you use dedicated information and strategies, then you have the right negotiation scripts. And also sometimes it tells you are perfectly aligned with the market. There's no need to negotiate higher payment terms, correct? And then also in the combination with financing, what does it mean? So I think it's not repetitive. It's very powerful, because in every negotiation, if you are prepared with information which the counterparty doesn't have, then you have a competitive advantage and you are more likely to be successful. Now, repetitive could also be the question, like, if you do it all the time, so where does it end with improving your payment terms? And I believe right now, it's always, we work mainly with one party, correct? Either the party is acting as a buyer or as a supplier, and they have this competitive advantage with having access to this information. What we see now, what we work on, is kind of the full transparency across the market, where both parties, the buyer and the supplier, have access to the same information, and then they can negotiate. So where you find the perfect break-even point, where maybe one party, they're looking more for better pricing, the other party maybe better cash flow. So this is, I think, is the future, and then there's no more repetition.
Yeah, no, makes sense. The script is adapted based on the data you feed it and on the outcome you want to have. That makes total sense. Final question. That one's for you, Wayne. Working capital notes, are they also in tokenized form available?
Yes, in fact, that's what they are. They are the, if you like, the real world asset, which is highly transferable, as I explained, with a simple signature, simple endorsement. They're also fractional, actually. They can be fractionalized. So, in terms of the flexibility of using them for distributing risk to providers of capital that have the risk appetite, that's another use case that we're exploring. The point about the working capital note itself, I think, is just making sure it sits within an embedded workflow. So we, it's end to end. So we take the data from an ERP system, we produce the notes. It's then held by the holder of the note. That can be then transferred, with a full audit trail, and the UK law requires a reliable system. So yeah, for Francois' question, thank you for the question, but yes, absolutely, they are absolutely in tokenized form.
Yes, sounds great. Sounds great. We've already ran over. I do see there's one more question. I will definitely link that question to Oliver and make sure you will get your answer on a one-on-one basis, which might be even better. Thanks a lot, Jessica. Thanks a lot, Wayne. Thanks a lot, Oliver. I learned a lot today. I learned new things today. I think the small summary is the sweet spot is the combination of data, technology, negotiation strategy, and gradually optimizing your working capital to finally maybe reach a real-time treasury, real-time working capital. But we need to fix some requirements first. Take baby steps. Don't go big bang. Your procurement won't like that. Your treasury definitely won't like that. If you have further questions to ETR Digital, please contact Wayne. For the AI part and the analytics part, contact Oliver. For all other questions, general questions, feel free to reach out to me or Jessica. You will find us on LinkedIn, or just reach out on Masterminds. Thanks, guys, for being part of this panel, and have a look out for our next sessions. Thanks a lot.
Thank you.
Thank you.
Yeah,
Bye.